Okay, awesome. Oh, right. So I know you guys are very, very interested about the whole stock and investing piece. So we are gonna go through the first couple of slides fairly quickly, but I did want to give you an introduction about myself and why I'm here and why I'm going to be telling you guys all the information regarding stocks and money. So my name is Rachel Smolka. I've lived in Staten Island almost my whole life. I went to St. John Villa Academy, which obviously is closed down already, but that's where I graduated high school from. From there, I ended up going to Quinnipiac University in Connecticut, and I majored in international business and I minored in Spanish. And right from there, I was very lucky and ended up getting my first job at Morgan Stanley. I was there for quite a bit, maybe like 12 or 13 years. From Morgan Stanley, I went to JP Morgan. And from there, I went and switched over from corporate America to going into more of a startup tech type of environment. So that's what I do as pretty much my day job. As far as this piece is concerned, I'm very passionate about working with students, helping them learn the process on how to get a job, and also going through and discuss how, once you actually have a job, how you're going to manage your money. Because I think one of the main problems is we don't really teach students a lot of this information, definitely not in high school, and maybe kind of gloss upon it a little bit in college. And it's definitely a really important topic. And the other key thing to remember too, because as you're looking at all the grownups in your life and you think about what you want to do in your life, at some point you'll be making, you hope to be making a pretty decent salary. And as you get older, you're going to realize that no matter how much you're making, whether you're making 50,000, 100,000, 200,000 a year, if you don't know how to manage that money, it almost doesn't make a difference. In my experience at Morgan Stanley, when you talk with very senior people there, I've had one boss, I remember we were going through like an economic downturn, and there was a possibility that we were all going to be getting laid off. This was someone who was maybe 2 or 3 levels above me, very, very concerned about losing her job because then she might potentially have to lose her home. And it's like, I'm here making, 60, 70 grand at that time. You're probably making like $200,000, and that's something you're worried about. Like, I wouldn't have thought someone at that level would be worried about something like that. But it really comes down to, doesn't matter how much money you make, it's really how you manage it and how you invest it and how you can unlock the secret about how you can turn your money into making money while you sleep. You're going to be set. And that's kind of what we're going to go through during this presentation. Can you skip? I think I actually just jumped ahead. Right here. Okay. So a little bit of background about what I do. So I'm a financial operations consultant. That's what I do by day. What that actually really means is, when I was in corporate America, I was helping set up all of the back office financial operations. So when you think of like, how does someone get paid? How does the payroll work? How do we open up a bank account for a company? How, if we're growing and we're going to another country, if we're going to Italy, how are we going to pay those people? Those are the kind of things that I was doing when I was at Morgan Stanley and JP Morgan. At some point, let me see, maybe about 3 or 4 years ago, I was given the opportunity to go do this for a company called WeWork. Has anyone ever heard of WeWork? No? If you have time after the call or sometime next week, I would definitely Google it. It is quite the story. They're actually making an Apple TV series about WeWork. It was a huge, huge company that expanded incredibly rapidly, went into maybe 30 plus countries, and they were just about to go through IPO, and the company completely tanked so hard that when it was time to lay people off, we actually couldn't lay people off right away because we didn't have the money to pay their severance fees. So anyways, it's a very interesting story, but I was at WeWork and I was there to help them basically do exactly what I was doing at Morgan Stanley and JP Morgan, but for that startup type of company. They were buying companies, so going through merger and acquisition activities left and right. We actually had bought a construction company in Argentina. So that was a huge, huge project. And they were expanding internationally like crazy. They were opening up in Russia, in Italy, in Sweden. So we had a whole project team that was helping handle those back office operation pieces, like how do you pay people? It is not the same as you pay people in the US. You cannot pay them the same in Italy. You cannot pay them the same in Argentina. So you need to figure out what all those little behind the scenes rules are and implement it into the day-to-day life. So that's a little bit about me. And then as far as what I do on the side is I opened up a small business here in Staten Island, and I help people write resumes. I help people at all levels write resumes, but I really specifically try to target like the high school to college grad type of age, because I feel like, as I mentioned earlier, that there's a significant gap as you're going through school and going through the education process, that I try to help teach people the actual real process of applying to a job online, what that actually means and how you actually can get your resume seen. I selfishly started doing this more for myself, because when I was hiring interns and entry-level folks at these jobs, I was finding it difficult to get the right type of candidate, because I was finding candidates that maybe paid someone or somehow like knew the actual process, but when they would come in to go for the actual interview, people weren't able to make eye contact. They weren't able to answer my questions properly. If we would hire someone on a temporary basis, they would come in and they couldn't write emails properly. So these were all little things that I was starting to realize over time that were just not really picked up on in college for some reason. So I started doing this to really try to educate people so they can have one leg up when they start going through this process on their own. All right, go to the next one, please. Okay, so we're going to touch upon how to craft a resume, because that is also my first favorite topic to talk about is money. My second favorite is to talk about resumes and how to get a job. So we're going to go in order here, right? So if you're coming out of high school or you're graduating college, your main goal is going to be to find a job. So in order to find a job, absolutely step one is to have a perfect professional resume. So what I've provided here is a simple format and just a couple of bullet points for you, so that if you are trying to get an internship this summer, if you're trying to get a part-time job, you're able to do this resume on your own, and it will help you look a little bit more polished and maybe get your foot in the door. So always, 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 your resume should be tailored to the position you're applying for. Your resume should also have some of your most important things that you've done on top. So one of the main things that I tell every one of my clients is, when you write a resume, you always have to have a summary statement. And the reason being is that summary statement, when somebody actually looks at this piece of paper about you, the average time it takes someone to look at this is 7 seconds. That means that nobody is reading every single word of this piece of paper. We almost always read to the half of the page, and if something strikes our interest, we will read to the end of the page. So you want to always put your best stuff on top, and because you're trying to do an accumulation of what you can offer, you obviously can't put every single thing you've done in the top half of the page. So we try to put that into a 3 to 4 sentence summary statement. Please, 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 your resume should always be 1 page. When you get to the point where you've been working for 10 plus years, you're allowed to go into page 2, but you cannot go to page 2 before you've worked for under 10 years. A lot of times we find when we're trying to hire interns, they've done a lot of projects in school, and it's very hard to figure out how you want to articulate yourself and what you think is the most important. So people just throw everything onto that resume. It looks a little off when we have, entry-level people coming to us for jobs with 2-page resumes. 2-page resumes are reserved for people who have like 10, 15, 20-year career. So you want to keep it always under 1 page. The other extremely important piece on this, and I touched upon this a little bit briefly, is you want to be able to articulate your soft skills. Okay, does everyone know what soft skills are? No. Okay, think of hard skills or actual things that you learn in school or by taking class. So you might learn Microsoft Word or Excel, or now that everyone's doing remote school, right? I'm sure you guys are using Google Docs. Those are considered hard skills. It's a skill that's more about your internal personality. Do you have good time management skills? Do you have good communication skills, good written skills? Those are the kind of things that when we're hiring people, we're looking for. So if you can articulate that on your resume, it will help us as we're going through the interview process. So typically what I do is under the summary statement, there's a little space. You can kind of see it in this sample, but that's where we put some of the soft skills. So in this example, we put customer service, self-motivation, developing others, organization. Those are qualities that we look for that people often overlook and don't think to include in their resume. And the last piece, as far as the resumes are concerned, is really don't be afraid to sell yourself. The whole entire point of a resume when you're going for your job is it is your marketing tool. It is your personal advertisement. So you want to write it in a way that reflects the best version of yourself, summarizing everything that you have done in the past and showing that what you have to offer for whatever job you're applying for. So it is very important that you are not afraid to promote yourself through your resume. Does anyone have any questions? All right, let's talk about the money. Before we get started, is there anything specific that you guys want to make sure we talk about today regarding money?
Are we going to be talking about like how stocks work?
We are. Talk about how stocks work. Do you guys know what financial independence means?
Financial independence means that you can support yourself on your own income and not from anyone else's.
Yes, it means that, but it means there's one other component with financial independence. So financial independence means you absolutely can support yourself without help from anyone else, but you can also support yourself in the way that you want to support yourself. So for example, in what we talked about earlier today, when somebody might potentially get laid off, if you are going to get laid off and by your next paycheck, you think you're going to lose your home or you can't pay rent or you're not going to be able to pay your car payment, that's really not financial independence because you're basically living paycheck to paycheck. So at some point early on when it literally could be any point. It could be now. As you're a teenager, it could be now. If you learn to be financially independent, you will not ever feel that like crippling feeling that if you lost your job or your car broke down and you've had an emergency payment, that your whole life will end because you have plans ahead and you're able to support yourself through those type of emergency kind of situations. That's really what financial independence is. Another example here, I'm here today. I'm not working. I stopped working today at 2 o'clock because I wanted to do this because I very much like to do this, but I'm not getting paid. So I'm not getting paid today for 3 hours, but my life is not going to end. I'm not going to not be able to pay my mortgage payment this month. I'm at the point in my life where I have a decent amount of financial independence that I could do things like this. I could take days off. I can go on vacation and go to places that I would like to go because I have plans for decades at this point, probably 2 decades, to get to that position. So as we go through this, we're going to touch upon like how you can get there. And although, I mean, I'm super excited that you guys were interested in this because a lot of people don't really care about this at your age. But if you start at this age learning about how to do this, it becomes a lot easier when you're in like your mid 30s, 40s. Like this becomes like a very, very simple thing where if you don't start now, you're going to wake up one day and be 40 and be like, oh my God, I can't go on vacation, or oh my God, I might lose my house. You don't want to be in that situation. So starting young is always the absolute best. So as we go through this slide, we're going to learn to understand general financial terms. We're going to understand the importance of compound interest. Have you guys heard what compound interest is at all? The most important part of this entire presentation, and it's actually my favorite slide. So when we get there, we're going to spend some time on it. It's honestly, to me, it's like magic, but compound interest is very important. And we're going to understand what debt means. And that's where we'll get into the credit cards, how to get a credit card, why you should get a credit card, why credit cards can be dangerous, why they can be beneficial. So at the bottom of the slide, I wrote important to note, financial independence means different things to different people. Planning is always key, along with patience and motivation. That patience is going to tie back into the compound interest that we're going to be talking about. You start as early as possible, and you're never too old or too young to gain control of your finances. So if you have parents and they're in their 30s or 40s and they don't know this, you can literally go home and teach them what you're learning today. And if they start tomorrow, it is better than never starting at all. And that was my last point, actually. Knowledge is power, pay it forward. So what you're learning today, talk about it, look up some more information, research, Google, talk to your friends. You'll start learning more as you continue to talk about it and read about it. Okay, so type of bank accounts. There's basically three main type of bank accounts. There is a checking account, which you can go and open up at your regular bank, and that's typically what people use to pay their bills, because you can basically withdraw almost as many times as you want. So if you have 10 bills that you're paying every month, you can pay them out of your checking, no problem. The savings account, on the other hand, I think the federal laws, after 5 withdrawals, they'll start to penalize you. And if you actually withdraw like a lot every month, they might make you close down your savings account because they don't want you withdrawing more than whatever the number is, 4 or 5 times. There's a regular bank account or regular savings account. That is typically the savings account that if you walked into, JP Morgan, Chase, or Victory Bank, you can go there and you can open up your savings account. Typically, the interest rate on those savings accounts right now is like peanuts. It's almost better to just leave it under your mattress. I think giving you like 0.01% interest, which means for like every $1,000 that's in there, it's making like 10 cents or something. It's nothing. There is something called the high yield savings account, oftentimes referred to as a HISA, HYSA. Those are bank accounts that are tied to an online savings account. So if you Google HISA, there'll be piles that come up. I personally use Marcus by Goldman Sachs because I am familiar with the name Goldman Sachs. And I just like that it's with a specific bank that I know. But it's basically a savings account that's linked to my checking account that's at a normal bank that you can walk into. But the interest rate that they give in these bank accounts are typically significantly higher than at a regular brick and mortar bank. So currently, I think it's about 0.5%, which is 0.5%, which is not good because the interest rates are very low right now, but certainly better than 0.01%. So if your money is going to sit there and do nothing, you might as well have it sit there and make the most it could make, as opposed to sitting there and making the least it will make. So we keep a bunch of money in these online savings accounts. It's also nice because you have access to your money, but at the same time, you have to transfer it back to your checking account. So it eliminates that feeling like, oh, I have $200 in there, let me just walk to the bank and take it out. You actually would have to plan. I think it would take maybe like a day or two to get the money back into your checking. So it helps as far as like frivolous spending and that type of thing. It kind of really just sits there and makes the most money that it can make. The third type of account, and this is where the stocks and then investing comes in, is called a brokerage account. Brokerage account allows you to buy and sell a variety of investments, ETFs, mutual funds, individual company stocks. You can do that with a brokerage account. You guys have any questions?
Is there a penalty for moving from a HISA to your checking, like back and forth, or it just depends on where you go?
It will definitely depend on where you go, but that typically is not a fee. That's how they get you, because they want you to come to put your money there. So they don't want to charge you that. So, I mean, if you found one that charges that, that's definitely not the one you go to, but all the ones that I've seen, they don't charge for that. But yeah, anyone has a savings account, you should 100% be putting your money in a high yield savings account.
Question.
Sure.
So, I'm Muslim, and so we're not allowed to gain money from interest, but that's interest in the regard that the banks are making money off of like loans and stuff. So where does the interest from like the savings account come from?
So it typically comes from the investments the banks are making. I don't know if that's coming from loans to other people or companies, or whether it's just investments that they're making directly into other companies. That would definitely be something you would have to ask the bank that would own the HISA that you would look into, if that's the line in the sand as to whether or not you could do it or not.
Okay, thank you.
No problem. And I'm going to look into that myself too, because I don't know. I'll find one or two and I'm going to ask that question as well. Okay. let's move on to the next slide, the brokerage account terms. Okay, so risk. Can anyone explain what risk means?
Chris, I think you could
Um,
definitely talk about it, or whoever else.
It says the possibility of losing money on an investment.
Yes, and it's your appetite to how much you're willing to lose. So think about too, if you go to, well, if you're older and you go to Atlantic City, you want to go gamble. How much are you willing to lose? Is it $50? Is it $100? That would be your risk appetite, right? So you could potentially lose everything when you invest, but you can also make a lot of money. So you have to balance your want of wanting to make more money with the potential of losing money. So that's what risk is. Stocks are investment within, it's investments of an ownership share of a company. So what that means is if it's a publicly traded company, they have X amount of shares that they allow an individual or another company to buy. Once you buy a share of stock, you basically have ownership into the company. Somebody like you and I, we're not buying millions and millions of dollars of stock, so our ownership is like a teeny slice of a half of a percentage of the company, right? This teeny little bit. But it basically gives us a small ownership of the company. So if the company does good, the share that you buy is increasing. If the company does bad, the share is going down and you're losing money. So for example, a company that I personally invest in is JP Chase. That bank has been around for a gazillion years. I used to work there. I bank there. I feel like it's a solid company and I invest my money in there. So as an example, before Corona hit, the bank share price was around $140 a share. When Corona hit, it went down to somewhere below 80. I don't remember. So if you had bought at the height before Corona, you would have bought it for $140 and then it would have went down to $80 and you would have technically lost the money had you sold the share. But because you didn't and you're just sitting on it, you didn't really lose or gain anything at this point. You just own the share that was worth $140 and it's now worth 80. Fast forward a year into the pandemic, JP Chase is, I think it was $150 today. So not only did it recoup everything that it lost, it went up some. So you would have actually gained money had you chosen to keep it and sell it around now. So that's pretty much how that works. I mean, we'll get more into it, but we're just going through the definitions right now. Exchange traded funds, often called ETFs. That is a type of security that involves a collection of securities. So it typically tracks an underlying index. What that means is almost every group of companies or commodities are put into an index fund. So the most popular index fund in this country is, one of them is the S&P 500. So that index fund tracks the S&P 500 as a benchmark, which is the top 500 companies in America. So basically, if you put money into that index fund and you buy a share of that fund, similar to buying a share of a company, you are betting that those 500 companies as a group are going to be going up. And a common term that we use is you're betting with America. You're not betting against America. When you buy a share of the S&P 500, you're betting that America is going to continue to move forward in a positive way through the economy. So again, me personally, I actually happen to very much love the S&P 500 index fund. I do also have some money in there, both in my normal brokerage account and in my retirement accounts, because I am betting on America that it will continue no matter what over time to continually increase its share value within those companies. Bonds, not a big fan of bonds, to be honest. I'm going to tell you what they are just so you know, but not a big fan. So it's a fixed income instrument that represents a loan made by an investor to a borrower, and typically the loan is with the government. Bonds typically offer a teeny tiny interest rate. So because you have a higher chance of making more money through a stock, people that are your age, even people that are my age, and I'm almost 40, and people a little bit older than that will typically not need to have to go into the bond game because they have a higher risk. Now, maybe if I was like 75, I might move some of my money into bonds just to have that more a higher sense of security. But at this age, I honestly don't even have any of them because they offer such a low interest rate that I'd rather just keep it in my high yield savings account than spend the time and energy moving it over into the bond market. And compound interest, which again is my best friend. And if you remember absolutely nothing from this presentation, I want you to remember compound interest. Compound interest is the interest calculated on the initial principal of an investment. It accumulates from previous periods, and in the long term, there can be significant gains from compound interest. Now, what does that mean to you guys? And if it means nothing right now, that is totally fine. But what do you think that means? Do you see that? Is the slide up how compound interest works? Yeah, okay. So this is a graph, and this is very, very simple math. This graph is basically saying if you invested $1,000 a year when you're 25 years old, and you do it every year until you're 65, at the end of that time frame, you're going to make, and if you look at the very bottom right, it says you're going to have $303,000. Now, what you're doing is we're saying $1,000 a year for 40 years means you're putting $40,000 out of your pocket, out of your hard-earned money that you're making from your real job as a grown-up at 25 years old. And over time, because you're investing in stocks or index funds or whatever you've picked, the general consensus is that you would make an 8% average return on your investment every year. That's average. So that means maybe one year you make 15%, maybe one year you lose 5%, but over the course of 40 years, it is very fair to say that you can average 8% interest rate. So that means if you put $40,000 out of your pocket for 40 years, you will have made $263,000 just by having the money invested somewhere. Now, what does that mean to you? Does it feel like it's magic?
How do you do that?
So you pick, well, when you start, so if we're 25 and we're starting, we're going to pick a very, very easy item to invest in. Again, I'm not here, I'm not an FA, so I can't even give you like official advice. But what I do is I started with the S&P 500 funds, because again, when you pick an index fund, you're not betting on one company, you're betting on whatever that index is grouping. So if you buy a share in the S&P 500 funds, you're betting on 500 companies to do good over the long term. So if you're asking my opinion, I would say if you know absolutely nothing about stocks and you want to start, do it with an S&P 500 index fund. And there's multiple of them, but each bank has its own version of them. It tracks the actual S&P 500, because remember, an index fund is a fund that's tracking something else. So the something else that it's tracking is the actual S&P 500 market. So the funds, if the market's going up, the fund goes up. If the market goes down, the fund goes down with it. And there's a JP Morgan one, there's a Vanguard one, there's a Morgan Stanley one, there's a bunch of them. You just pick the one. I always go for the one that has the lowest fee, and I pick that one. So as your 25-year-old self, if you decide to do this, you can feel very safe that you should have around $300,000 when you're 65 years old. Sounds amazing. Can you turn to the next slide, please? This slide, although looks very similar, this slide is saying, you know what? I ended up getting a summer job. I'm 17. I'm going to start doing this plan now at 17 years old, and I'm going to invest $1,000 starting at 17. So it's only, 7-8 years difference from starting at 25. So if I do it till I'm 65 again, over the course of my life, I've now taken $48,000 out of pocket as opposed to 40 if I started at 25. And at the end, when I'm 65 years old, I have $572,000. So I would have made $524,000 on interest. That is, where are we at? 150, 60 something thousand more, just because I started at 17 instead of starting at 25. That is what compound interest does. And that is why it is so incredibly important that the younger you realize how this works, the potential more money you will have in the later years of your life. Because the biggest gift that compound interest can give you aligns with time. So if you start when you're 60, you may only have 10 years or so to invest that money. But if you start when you're 16, 17 with your first job, and you just put, even if you put $500 in there, you're letting that $500 sit there for 40 something years. If we actually kept going on this graph, it's quite amazing. You can do this graph and just keep copy and pasting the lines down the row. You held this money to your 80, you have well over $1 million. And although $1,000 is a lot of money, absolutely is a lot of money, when you're working in your career, $1,000 is saving less than $100 a month. It's 1,000% doable. So, does anyone have any questions on this?
I have a question. So when you put the $1,000 in, where are you putting it specifically?
So you have to open up a brokerage account. And nowadays, and again, I'm a little old school, so I like to have it, as I mentioned, I'm at JP Morgan. I like to go into the bank and talk to my guy. I like to do that. You can still do the Robinhoods, the E-Trades, all of that stuff is there and available. E-Trade was actually just bought by Morgan Stanley. So they're backed by big banks. So they're not fake, they exist, they cover the money. You would open up a brokerage account at any place that that offers brokerage services. And then you would buy a share of something. So if you wanted the S&P 500 funds, actually, hold on, I'll tell you what it was today. So the SPY is the spider index for S&P 500. That one was $390.95 today. So if you decided that you wanted to invest $1,000, you would basically be buying 2.5 shares or whatever it is. You can also say, you know what?
Question.
Sure.
Can you go into investing with the student account, or it has to be like an independent account?
With a what kind of account?
With a student, like under someone else's account, or it has to be your own account?
No, you can, and I think that's the next page. We're going to talk about the ones that you can actually do yourself versus ones that you would have when you're an adult. But yes, if you read, I know you guys have heard all about the GameStop craziness, but if you read some of the people that have gained from GameStop, there are piles of like teenagers that were dabbling and investing through their Robinhood account or their E-Trade account and have made money on that. Now, again, I'm not saying do GameStop at all. What I'm saying is people your age are knowledgeable and are in this game. This is not just for people who are 40. This is, if you understand how this works, you can do it at any time once you're working.
I have a question too. So what exactly happened with GameStop stocks and AMC stocks, for example? Because I keep on seeing videos and I watch them and where they try to explain it, but it still like seems confusing to me.
It is very confusing. I will do my best to explain it as well, but it was regular people, again, 18-year-olds, 17-year-olds, 25-year-olds, just regular Joe Schmoes off the street that were going against the hedge funds that were shorting the stock. So when someone says I'm shorting the stock, like even with me, I've been researching and doing this for probably 10 or 15 years. I would never short a stock because it's a very confusing process. But what shorting a stock is it's basically these big hedge fund companies are betting that the stock will go down. When you short a stock, you're borrowing a stock from somebody, selling it immediately, and then hoping it goes down. So if I bought it at $100, I sell it in almost the same transaction for $100. Now I have $100 in my hand. And now I'm hoping that the next day that stock goes down to 50 so I can buy it back and pay the guy and I make money off of that. That's what you hope for. So you hope everything is going down. Because they use the power of social media, they basically rallied like who even knows how many thousands of people and millions of shares or millions of people and hundreds of shares, I don't know, whatever the number is, but they rallied to buy all of these shares for literally no reason, which caused the share price to go up. So all the people that were the people, when I say all the people, it's all the hedge fund companies that make millions and billions of dollars that are all betting that this stock is continuing to go down, all now had to pay the difference in price. So if they're thinking, if they buy this thing at 20 bucks and they're expecting it to go down to 15, they're going to make $5. They now have to cover the spread of the difference when the stock went up to $300. And they have millions of those shares. It's not like they have 10, they have piles of them. So they now owe the difference. And because of that, the stock price, because of the people were inflating it and just kept buying it and buying and buying it, and because the hedge funds had to sell it and buy it and buy it back like that, it went up and up and up and up. That is how that happened. It was like a complete anomaly because it was driven almost solely from social media.
I know like some companies like corporate, they do this thing called stock buybacks. And like I know they buy back stocks from people, but do they ask the people themselves?
It depends. So I can give you an example. So right now, I no longer work at WeWork, but WeWork has alluded to the fact that they want to buy back some people's stocks. So they do ask. In this example, they will ask, and we have the opportunity to say, sure, and I'm going to sell them back to you, or no, and I'm not going to sell them back to you. So I think it depends. They also might just buy back general from companies where like a regular person would have no idea, and they make those deals with the actual companies that own the stocks. Like people, like even like your, the teachers, your money is in the union is invested in funds. People are managing those funds and are buying and selling through those funds. So if one of the funds that is offered in your retirement package, if it's invested in a company, or let's say JP Morgan, we keep using that as an example, JP Morgan might come back because your fund has not your individual, but the teacher union for New York City as a whole, that fund is worth hundreds of millions of dollars. They might come back and ask to buy back some of those shares. So that would, as a individual person, you wouldn't really know that that's happening. They might send a disclosure statement, but honestly, people usually throw those things in the garbage. So it wouldn't be publicly disclosed where you would really know that unless you were looking.
Okay. And like buybacks are just a way for like companies themselves to inflate like prices, right? Because like scarcity and whatnot.
Yeah, they probably wouldn't say they're doing it to inflate the price, but yes, pretty much that's what's happening.
Okay, thank you.
And also if they think that this price is going to go up, they want to have their shares back. Like if they're doing something that's going to be very significant in the long term, they might want to take some of their shares back because then they'll be worth more and they can sell more of them.
Okay.
So basically, these people they're like taking a certain amount every year, putting it into the bank, and basically the interest just increases their money. Is that it, or?
The interest is the difference between what you bought it for and what it's making now. So a good way to like check some of this, or just follow a few stocks. If you go on, I don't know what it is on Android, but on your iPhone, there's just a very general stock app that comes with the phone, like the camera app. If you go on there and just put a couple of companies that you might be interested in, whatever they are, you can put GameStop in there, you can put the AMC in there, you can pick a bank, you can pick any public company, follow them, and just really watch how it works. If you come in today, so let's see, I'm gonna go on my phone right now. So Amazon went up 30 bucks today, and the market closes at 4 o'clock. So if you have an Amazon share, you would have made $30 today. And when we say made $30, that would be assuming you sold it. If you don't sell it, you basically make nothing. And if it went down $30, you didn't lose anything because you're still holding that share of stock. And as you start watching some of these, Tesla obviously is also a huge company that people follow and talk about all the time. Tesla, maybe 2 months ago, was at $900 a share. I own Tesla as well as a fun gamble stock for me. Tesla is now at 650. Had I sold at 900, I would have had more money, but now it's worth only $650 a share. But I didn't sell it. I didn't do anything with it. So I'm just going to keep holding on to it with the assumption that it'll get back to 900, if not go higher. So it feels like you lost money, but if you kind of get out of that mindset that like you didn't really lose or gain anything because you're just holding on to it. And that's also really the premise of compound interest, because the point is to keep it forever. You're not buying, like we're not talking about buying this and then selling it in 2 days. That's day trading, and that's very dangerous and pretty much on par with literally going to Atlantic City and just dumping your money into a slot machine. We're talking about long-term investing so that you can take advantage of compound interest, so you can set yourself up for life with financial freedom. And this graph depicts how it works over the course of 4 decades. It doesn't work in a year. If you even look at the year, like let's see, at 17, you put $1,000 in, we're estimating that you make $80. That's not exciting. Almost at 17 years old, you're probably like, well, I don't care about the $80, but it's the consistent yearly contribution that starts to make this work. So when you did it at 17 and all of a sudden you wake up one day and you're 40 and you're like, oh my God, I have $72,000. That's a little more exciting. But the excitement doesn't happen for literally decades later, which is why a lot of people don't do this, because what's 80 bucks? What's 200 bucks? Like you can make that probably on enough. I'm sure you can figure out plenty of other ways to make $200. It's the long game that you're in this for. And that's where the whole patience and motivation comes in. But this is how it works. And I can tell you that when you actually have your real job, you probably be putting more than 1,000 a year. Greatly turns that number that's 572,000, makes it higher and higher and higher.
So with something like the Tesla stock, right? Right now you said it was 650 where it was 9. When do you come out of that? Like if your intention is to make money off of that, right? Which is what I think the intention is no matter what. And you hold on to it for years and years and years. I mean, is there a way where you could say, or is there a time where you say like, okay, I just doubled or tripled my money, now I'm going to pull out of this stock? Or is that just, I know you said that's similar to day trading, but I'm not talking about every day doing it. But like, is there a point where you're like, okay, that just tripled or quadrupled, I'm pulling it and investing in something else?
That is very subjective to you, right? So I have money, the money that I put into Tesla, me personally, Tesla, like Elon Musk is a nut job, and he literally can go on Twitter and be like, you know, I hate America and that stock will drop, or I love this and the stock shoots up. So to me, that's like almost a pure gamble. So when I say invested in Tesla, that was my fun money. That was my, I'm not going to AC this weekend. I'm going to invest in Tesla because I think it's fun. So I treat that investment very differently than my S&P 500 investment. So yes, had I known it was going to drop to 650, sure, I probably would have sold. But, and this is where we can literally talk about this stuff for hours. If you buy a stock and you sell it within 365 days, so within a year, you're taxed on that gains like you're taxed on your regular income, like you're working, right? So if I would have sold that stock, whatever I made, I would have to pay 30-something% to the government. If I hold the stock for more than a year and then I sell, I only pay, I think it's 12% or 15% on my profits, which is a very big difference. So I'm hedging my bets that this is just a complete fluke for now. And by the time I complete my 365 days, where it will now be considered long-term gains as opposed to short-term gains, that it would be better for me to even if it got back up to 800 and I only pay 15% tax versus selling now and paying 30-something% tax. But that's my personal investment for Tesla. People have like taken out mortgages to buy Tesla. Like that's a little nuts. If we're talking about the S&P 500 funds, I will never take that money out. That is the money that I hope to never have to use, and that just sits there and sits there and sits there until I'm old and I don't want to work anymore. And that's the difference too, like, because I've been planning, like me personally, I've been planning to do this for quite some time. I think, like, when you look at my, like, I have a version of this spreadsheet for my own self. My number to not work anymore is around 52, 53. I don't have to wait till 65 or 67 or 70, whatever it is. Because if my numbers are working out properly, I should be able to live off of the interest that I make every year. That's my plan for me personally. People's plans are different. Some people have no problem working until 65 and they spend their money and they do different things for that. But that is my plan. So to answer your question, it's very subjective how you're planning to invest whatever type of money. You might have fun money you're throwing into something, or you might have real money that you're planning to do something with, you know, decades in advance.
Sorry. What's your opinion on quick trades or like, well, I guess day trading, I think would be considered the term, but like minute trades or like within the hour, basically.
Oh, so I personally am not into that. That I really think you need to be like a professional with like your 85 screens and all the graphs and like software that's really checking algorithms and things like that. That is not me. That's not what I do for work. I do finance, but I don't do that type of finance. So I wouldn't even touch that. And to be quite honest, if you open up a regular brokerage account, there's questions they ask you. You can't just day trade out of a brokerage account. They will actually yell at you. Like they'll end up shutting you down if you did that a lot. So there would have to be a specific like account. Maybe the E-Trade, you can do it out of there, but I think like JP Morgan, the bigger places, they wouldn't let you do that.
So for example, right, let's say you invest in Apple and let's say Apple's worth like increased and your money increased, like your share increased. Can you like withdraw your money, or would that be considered like cheating, or you just leave it?
So you can, what we talked about like a couple minutes ago, if you buy a share in anything, if you sell it before 365 days, your profits are taxed as short-term gains, which means you're taxed like you were working at a job. So whatever your tax rate is. So if you did that now as a 16 or 17-year-old, I imagine you're not making $100,000. So your tax bracket is probably fairly low, 12 or 15%, you would be taxed like that. If you hold it for more than 365 days, you're taxed as long-term capital gains, and that tax is around the 12 or 15% mark. So for you guys, because you're at the lowest bracket of earning, because you're high school students, it probably wouldn't make a difference. For someone like me or your teachers who are making more money or who are married and have double income, you wouldn't really want to sell within that year because you would be taxed at a higher rate. Okay, let's go to, I don't know what slide you're on, but if you go to the one for retirement accounts, we'll gloss over the first two because they're going to be boring for you, but the last one is the ones that you guys can do. So we'll just go over so you understand what they all are. A 401k is a retirement account that when you go to your adult job, hopefully they have a 401k or something equivalent. Basically, it's allowing you to buy shares into a retirement account. Hopefully the company has a match, which means if you decided that you're going to put in 5% of your income, they might say, okay, we'll match you up to 3%. So at the end of the year, you're basically contributing 8% of your income, 5 out of your own pocket, 3 out of the company. So it's considered free money. And they invest it into whatever funds they offer. They usually give, I don't know, 10 or 15 different kinds of funds. And you let it sit there for retirement. If you pull the money out before you're 59 and a half, they will tax you as your normal tax plus an extra 10% because you're pulling your money out too early. It also reduces your taxable income. So what that means is, let's say you were making, or use easy numbers. If you're making $10,000 a year and you put $1,000 in, when you do your taxes at the end of the year, they will count you as only have made $9,000. So you will only have to pay taxes on $9,000. Because of that, because they're treating it as tax-free income in the beginning. When you now become 60, 65, 70, and that money has been sitting in there for decades, when you start pulling the money out to pay for your life when you're not working, that money is considered taxable income. So if you look at that last bullet, if you have saved $1 million and you decide to cash it all out, you're essentially only going to get $700,000 back if you're in the 30% tax rate. So whatever you have in that account, you have to always account for the fact that you have to pay taxes when you pull it out. Okay. The IRA account is pretty much the same concept, except you open it up at your personal bank. It has nothing to do with work. You can walk into any bank and say, I would like to open up an IRA account. You're allowed to put, every year they have a limit. This year, I believe it's $6,000. You're allowed to put $6,000 away. It reduces your taxable income. And the same thing, if you end up getting $1 million when you retire, when you pull that money out, they will tax you on it. So if you have $1 million and every year you're like, oh, I need $100,000 to live, I pull $100,000 out, but you don't actually get it. You get taxed on it just like you were getting a paycheck. A Roth IRA is what you guys can do the second you have an actual job that's giving you a paycheck. With your parents or your guardian's approval, you can open up an account, a Roth IRA account, and let's say you made $1,000 in the summer. You can contribute up to however much money you made, capped at, I think it's like $18,000, whatever the number is. So you make $1,000. If you chose to put the full $1,000 in there, you put $1,000 in there. If you remember our graph from a couple minutes ago, if you did that $1,000 every year forever, and it got to $1 million, and then you start withdrawing from there, you actually have $1 million. That money is not taxed when you pull it out. And that's the biggest difference and the biggest advantage of a Roth IRA account versus the other ones that you get from work. The minimum will depend on the bank that you open it with and the funds. Some funds have minimum funds and some don't. When you open up an IRA account, you can, because it's a personal one and it's not through a work, you can buy Tesla stock, you can buy Apple stock, you can buy the index funds, you can buy anything that you want because it's not scoped into just what the workplace offers. So you can still do, if you really love Apple and you believe that Apple will be around forever and it's going to continue inventing new things and people are going to continue to buy iPhones, you absolutely can buy Apple stock in your Roth IRA account and let it sit there. And that's the biggest difference, is the taxable piece. You do not reduce your income. So if you need the $10,000 and you give $1,000, you're taxed that year on $10,000. But that $1,000 is now growing for 40 years. And when you pull it out, you don't pay any tax. So it's just like they're handing you cash, tax-free. And just to highlight again, this is something that as soon as you get your first real paycheck, so not like an under the table job, you have to actually be on the books for something. But as soon as you have that paycheck, you are able to contribute to a Roth account, a Roth IRA account. And grown-ups, you're allowed to transfer your money. You would have to pay taxes on what you're converting, but you can convert money from your regular account into a Roth if you believe that you'll be on the winning side of having that tax-free money X number of years when you need it, as opposed to having it grow and paying the taxes then.
Naija asked, if you're investing, do they still take money out for Social Security?
Out of the investments?
I think that's what she's asking.
The investment is coming out of your like the money you bring home. So the Social Security is taken out of your taxes already, like through your paycheck. So if you're doing your Roth IRA and your paycheck is $1,000, the Social Security was taken out already. You're basically taking your after-tax pay and then deciding to invest after it. It's like the same if you're like, oh, I want to buy this $200 pair of sneakers, or I want to put $200 in the stock market. You're making a conscious effort on using whatever that money is that you have worked for and doing something with it. Oh, I can't, I don't see the comment somebody just wrote. I don't know if you guys can read whatever they just wrote.
Keith was just commenting on Nyaja's comment. He said, I think she means like profit, right, from investing.
Oh, no, it's just short-term capital gains or long-term capital gains. And so that's the big difference too. So again, as you guys, if you're interested in this and you start reading more about how this really works, when I commented before and said, I don't plan on working past 52, 53, I plan to live off of the interest that I make on my accounts. So when I say, if I say I need $100,000 a year, I would sell $100,000 equivalent of shares, and I would only be taxed on my long-term capital gains tax of the 15%. So I no longer would have to pay 30%, you know, all that other stuff, city tax, like that goes away because I'm living off of my investment income, which is taxed at either long-term capital gains or short-term capital gains.
What's a good rule of thumb when you want to diversify your investments, like your stocks specifically?
So again, if you're just starting and you have nothing in the stock market, I very much advocate for this S&P 500 fund because you're already diversifying in 500 companies. So if you just Google what companies are in the S&P 500 fund, you will see 500 companies that you probably recognize majority of those names. And every share you buy has a percentage in those companies. So you're auto diversifying yourself by buying into that fund. If you start learning more and more about it and you start investing in individual companies, then I would start, you know, get a utility, you get a bank, you get a consumer staple, supermarket, you just mix up. Like, for example, in Corona, piles of things did phenomenal in Corona. Home Depot, great. JP Morgan, skyrocketed. Amazon, Apple, all the tech stuff, PayPal, all that stuff did very, very good. Whereas the airlines tanked, right? Because obviously nobody was flying, nobody could do anything. The airlines before Corona was like United Airlines, for example, was around 90 something dollars. It's around $40 or $50 right now, right? So it lost half of its money. Now that the economy is opening, when you hear like good economy news, like, oh, the third stimulus came out, if you're really looking at the market, a lot of the tech companies have been going down because they were going up when everything was closed, because everybody was shopping online, using PayPal to buy all their stuff online. All that stuff was increasing. So all the tech stuff was going up and up and up. Now, as the economy is opening up and people are starting to move around, people get worried that the tech stuff is going to go down. So you want to make sure you have some stuff in tech stuff and some stuff in the other stuff. So right now, again, me personally, I am starting to invest more and more in the airlines, because if we felt that the airlines, if you believe that the airlines will get back to where they were pre-corona, the airline stock is $50 and it was $90. I'm almost going to double my money if I buy the airline stock. So now I'm starting to put more in there with the hopes that in a year or two, it'll get back to the $90 and I will have doubled my money. Not doubling my money overnight. I don't think the airline stock is going to get to $90 tomorrow. So long-term play, but whatever I put in today, I feel like I'll get close to double that within 1 to 2 years. And that's how you start figuring out how you want to like move your stuff around. What does that say? I can't read. So your investment doesn't have to be, I can't see anything after that.
Doesn't have to be consistent. So your investment doesn't have to be consistent. You can't change it based on how you see the outcome. You can. So it's all about what you feel and how you're setting this up. If we keep using the example of $1,000 a year. Some people might just put $1,000 in at one time. Some people, like I, like the every month
regular contributions. So if I was doing $1,000 a year, I would do the $90 a month or whatever that makes it out to be. And so every month, it's also a concept called pay yourself first. Every month I take what I'm going to invest in and I pick what I want. Right? I want the airlines. A couple months ago, I was dumping a lot into, when Corona first dropped again, I would put a lot in the bank and I put a lot into Home Depot. It ended up working because who knew, but people were going and buying stuff to do home improvements. So Home Depot and Lowe's and all those things have been going up. But at some point that shift will stop and there'll be less growth. Not that I'm going to lose money, but it won't be growing the same. And now that the economy is starting to open again, think of the movie theaters, think of the restaurants, think of what the cruise lines, all the things that people couldn't do that have been losing money, all those stocks have gone down. You want to find those ones that have gone down and buy them cheaper with the expectation that they're going to go up. So now this month, when I take the money that I know that I'm paying myself first, the money that I'm going to use to invest in my financial independence, I'm going to take that money and I'm going to put it in United Airlines. Actually, I think I bought some this morning as we're talking through that. I'm pretty sure I bought some this morning.
Can you explain dollar cost averaging?
So that is dollar cost averaging. When you buy things in multiple contributions, that's dollar cost averaging. And I'm a big believer in that, which is why I wouldn't just take the one lump sum of the $1,000 in our example and just buy it at one time. I like doing it every month to get an average price. Probably more because my personality, if I bought it one month at 20 and the next month it was 15, I probably would lose 2 nights of sleep because of that. So I like to just, okay, half was at $20, half was at $15. I'm okay with that. But that is what dollar cost averaging is. It's buying something in multiples as opposed to one, so that you get the average share price. So if you bought something at $100 and then you bought it again at $50, your average share price would be $75, which if you go back to the compound interest, that's exactly what you're doing. You're basically doing dollar cost averaging over the course of the year. So if you chose to do 12-month contributions, you're doing 12 months a year, or if you did one a year, over the course of the 40 years, you've contributed 40 times and you would have an average price at the end of what that would be. If you went in the same fund, of course. All right. What does anyone want to explain to me what they think of when they hear the word debt? Debt always feels very bad. Nobody likes debt. But there's good debt and there's bad debt. And it's very important to understand the difference and how you can leverage debt to help you. Yes, debt is money that you owe. It's exactly what that is. You're basically owing somebody, someone, some company, some car place, you're owing somebody money, and nobody wants to owe anybody money. However, there's a handful of good reasons that if you can be financially responsible, there is a few good reasons why you should have some sort of debt. And we'll get into that. So good debt is considered money that's owed for things that build wealth. So a mortgage. If you take a loan out to buy your house, not only do you now have shelter for you and or your family, there's also the assumption that whatever you bought, which is your house, would grow in value over time. So although you're taking a loan out and you pay that loan back, the loan is called a mortgage. If you decided to sell that house in 10 years or 20 years or whatever it is, you would be selling it for a lot higher than what you paid for it. And therefore that debt would have allowed you to make money. That's considered good debt. Another example of good debt is if you had to take out a student loan, you're investing, you owe the money to the bank, but that money that you're borrowing, you're investing it in yourself to hopefully get a higher paying job to support yourself and your family. That's building wealth, and that's considered good debt. Bad debt is debt that you go into for just buying nothingness. You get a credit card and you decide that you want 5 new pairs of sneakers, whole new wardrobe, makeup, and then at the end of the month, all of a sudden you owe $1,500 and you only make $500 a month, and now You are paying the bare minimum on the credit card, and your $1,500 payment or $1,500 purchases are now costing way more money because you're paying interest onto the bank every single month. That is bad debt. Nobody wants to get into bad debt. I would highly recommend that you never ever get a credit card unless you can put whatever is on your credit card and pay it off in that same month. If you can't do that, don't even bother getting a credit card. Interest rates. So interest rates is what percentage you're paying on the money that you're borrowing. So similar to when we talked about compound interest, there's money that you're making investing, it's paying your money back. It's the opposite for debt. You're paying the person or the company that you're borrowing the money from, you're paying them a percentage. So if you borrowed $1,000, you're not paying them back $1,000. You're paying them back maybe $1,050. That $50 is the interest that you're paying for borrowing that money. Mortgage rates have dropped significantly. I actually think they're less than this at the time I wrote this. 2.875% is wonderful. When I first bought my house, it was 6%. That is terrible. So I had to refinance at some point because the rates, I had bought my home like right before the recession hit. So all the home prices were significantly high and all the interest rates were significantly high. So I ended up having to refinance so that I can get down to a lower rate, because otherwise I was paying 6% on all the money I borrowed, which is a lot of money. Credit cards are around 24, 25%. That is insanity. So if you've spent $1,000, you will be paying, and you decide to not pay it back, you will end up owing $1,250 on that $1,000 investment, $1,000 purchase that you bought. Credit score. Who knows what a credit score is?
I don't really know that too much about it, but it's like a certain like number that can like help you like get out loans and just be able to like buy certain things, because like companies and just people look at it and they see like if you have a good credit score, then you're more likely to like be like good at paying off things. If I don't know if that kind of makes sense.
Yes, that's exactly what it is. And if you don't know what a credit score is, I would definitely get yourself familiar with it, because credit score is pretty much it's a huge component of your financial life, and everything that you want to do as a grown-up almost always revolves around your credit score. So a credit score basically is a number from like 0 to 850, or 300 to 850, I'm sorry. And it's broken down into 3 parts. So if you see here, if you have a credit score between 670 and 739, you're considered good. 740 to 799 is very good, and over 800 is considered excellent. When you go as a grown-up to go buy your house and get a mortgage, or you're 18 years old and you need to go get a car loan because you want to have a car, that is all revolved around your credit score. So if you have no credit score, you're not getting a car. They're not going to give you a loan. They're not going to give you a loan to buy a house. If you have a bad credit score, you probably will also not get the loan, or you would get the loan at a significantly higher interest rate than had you had a good credit score. The way you get a credit score, so if you don't have any bills in your name or a credit card, you probably don't have a credit score, which means, again, at 18 years old, if you decide you need to get a loan to buy a car, you can't do that because you don't have a credit score. To get a credit score, there's a couple things you can do. If you had a utility bill in your name, that starts to grow your credit. Or you can also get a credit card. So I want to be very, very, very clear on this. I am not telling you guys to go get a credit card. What I'm telling you is, at some point in your life, and that point could be when you're 17, it could be when you graduate high school, it could be when you're going to college, you will be offered a credit card. The credit card will 100% help you grow your credit score if you do it responsibly. If you get the credit card and you get another credit card and you get a third credit card and you don't pay your bills, you are digging yourself into a horrendous, long, deep, dark hole that it is very, very hard to climb out of. So if you don't think you're financially responsible enough, do not get the credit card. But if you think you are, it is wise to get the credit card because it will help you grow your score which will allow you to get better rates when you become a grown-up and you need to get your car loan or get your mortgage. Anyone have any questions on that?
Yes. So let's say if I have like a credit card in bank A, for example, and then I have a good credit score there, and I went to bank B, would my credit score like transfer like thoroughly? And if I had good credit score or bad credit score?
Yeah, so your credit score, think of it almost like your social security number. It's with you all the time. It doesn't matter what bank you go to or what car company you're going to get your car from, or if you want to go to Apple and you get the Apple phone, that credit score is tied to your name. And when somebody runs, when I say somebody, when a company runs your credit score, they're filing with the credit bureau and they're getting that score from you. Doesn't matter if it's bank A or bank B. They're all going to the same like 3 companies to get your credit score, and they're getting the results sent to them. So you can't just like not pay one bill and be like, oh, my credit score is bad with this company, and now I'm going to go get another phone and I'll pay this bill and it'll be fine. That's not how it works. It's with you forever.
Thank you.
No problem. So let's assume that you guys are 17 and you have got your first credit card. And let's assume that you pay all of your bills on time. So every month you know that you have $100 like cash in your pocket and you want to grow your credit. So you, instead of using the cash, you buy $100 worth of stuff in your credit card and you just pay the $100 as a bill. That is a perfect way to increase your credit score. What people don't always realize is they think that just because they pay all of their bills on time, that means they have a good credit score. A key component to getting a good credit score is this second bullet, which is called the credit utilization ratio. What that means is it takes the amount of debt that you were given from your credit card. So if the credit card gave you $1,000 limit, it's basically saying, I believe that you can pay me back $1,000 of purchases. If you say, yeah, I have a job that pays me $2,000 a month, so I can go ahead and charge $1,000 on my card and I'll pay the $1,000 back, no problem, I pay it on time. That would ding you slightly because your credit card ratio is now 100%. You have 100%, you've been given $1,000 in debt and you've used $1,000 of debt. 100, you've used all that they've given you. That is not a good look for them. They basically want you to only use 50%. So if they've given you $1,000 limit, the expectation is that you only need to use $500 of that. So it's just something to know, because if you get your credit card and you use it to the full limit, and even though you pay the bill every month, your credit score would be a lot higher if you only used half of the limit. And that limit is an aggregate of all your cards. So again, we're 17 years old, so the expectation is you're not going to get 3 cards, but at some time you're going to have 2 credit cards, you might have a gas card because you get points, like you might have a whole array of cards and you're managing it well, but the credit bureau will take a look at the total limit of all the cards, the total amount that you charge every month, and that's how they're going to get that ratio for your credit score.
So I know when like you get married, right? So technically you're not 2 separate entities, you're one. So does do your credit scores average, or do they like turn to the lower credit score?
No, individually, you're always going to have your own credit score. When you talk about getting married and everything merging, like if you end up getting like your house, if you put your mortgage in you and your spouse's name and you don't pay it, you're both of your scores is going to go down. Or let's say your spouse got a car and you helped co-sign on that loan with the assumption that your spouse would be paying the bill, and then they chose not to pay the bill, that would ding your credit score as well because you're on the loan. But your credit score is individual to you. It's just if you took a loan out with someone and either that someone didn't pay it or you and the someone didn't pay it, you would both be affected because your name is on that loan. Same things like with your student loans. If you have your parents co-sign for you and you just decide you don't feel like paying it anymore, like you would be wreaking havoc on your parents' credit score because they're tied to the loan. So surprisingly or not, in my family, I take care of all the finances. And when I ran our credit scores, my husband actually has like a couple points higher credit score than me, which pissed me off to no end because I'm the one that does everything. And it's because of this credit ratio, because there's a credit card that we have in his name that we use specifically for travel. And that credit has a high limit. So for him, it appears that he uses less credit because that one is in his name, whereas like our joint card is for both of us. Interestingly enough, I actually just learned last month, and I'm going to be looking into it myself for my own daughter who is in high school. There's a credit card called STEP credit card. It's the guy is from California. It's like a startup company, and it is a credit card that you can give to a child that allows them to grow, to gain credit, but it works as a debit card. So like, I don't know if you guys have debit cards, but my daughter has a debit card, which she keeps her own money in there. So if there's $50, she can only spend, is it that D'Amelio one? Because she's the spokesperson for STEP card. So so it works like a debit card. Yes, Charlie D'Amelio. Yes, she's the spokesperson for this. So actually I went on LinkedIn. I don't know if you guys know what LinkedIn is. It's basically like the business social network, like Instagram, but just for professionals. And I follow Alex Rodriguez. Alex Rodriguez has a specific company that's investing in STEP. And I made a comment and said I would love to hear more information about this because I do go to high schools and I talk about money. And the CEO of STEP commented back and like sent me the link of the website to learn more about the card. So the card actually works like a debit card. So a debit card, if you had $50 in your bank account, it wouldn't let you spend more than $50. The STEP credit card basically links up to your account. And if it only had $50 in there, it would never allow you to charge more than $50. So you eliminate that risk of ever going over. And it will start helping you build credit because obviously as you know, a 15, 16-year-old kid, you don't really have the opportunity to build credit at that age. So it's just something to think about and look into if you're looking to start your journey into credit scores.
So essentially it's a secured credit card.
Basically a secured credit card. Mm-hmm. A prepaid card would not help with your credit score. It's basically like a gift card. It's just, I mean, Visa and like the credit card companies issue them because it's just an easy way for people to give gifts, right, and buy stuff. But it's just like a gift card. It doesn't do anything as far as credit. Just like a debit card doesn't help your credit score because it's not debt. The whole point of credit is saying like you are a responsible person to handle debt. So I will leave you with the last. Okay, the second to last slide is financial literacy. Since you guys have sparked an interest in this, my suggestion, like what I just taught you is great base, but I mean, we could literally talk about this for like 20 more hours. My suggestion is to read. In my reading suggestion, I have put in the Wall Street Journal, but I can tell you that I know that nobody's going to read the Wall Street Journal. I happen to like the Wall Street Journal, but it's probably very boring. The USA Today money section, you can get the USA Today app for free. The money section frequently provides like very, very easy reads on almost all the topics that we just touched upon. Some of them you might not be interested in, but there's going to be piles of them. They went through a whole summary of GameStop. They talk about the Roth. They talk about what to do if you're a teenager and looking for money. So that's a free app that you can download and you can get some good money advice on there. There are some books, The Motley Fool Investment Guide for Teens, the OMG Official Money Guide for Teens. And then of course on Instagram, literally just search money. You could find piles of people on Instagram that post money tips. These are a couple I follow: The Financial Diet, Economy Cat, Invested Millennial, Be Worth Finance. And then I threw, of course, mine in there. And I talk usually tips about jobs and getting jobs and I hear of places hiring people, I usually post on my account. So you can do it. I 150% know that you can do this.